There, it's me, Stephen Thomas, with Reports on Housing, bringing you yet another housing debrief. I invite you to smash that like button and subscribe to our YouTube channel just so that we can get this good information out to as many people as possible so they can make great decisions for themselves and for their families. This week, we're going to be talking about the housing market is broken. And it has everything to do with the Federal Reserve. Now, the Federal Reserve and their change in rates. They met this week, and yesterday, Jerome Powell, the head of the Federal Reserve, came out, and he sounded a little bit more on the dovish side of things. That means that, yeah, you know what? We don't quite know where we're going, and we're not going to go as fast. Not as hawkish as he's been, where they've been extremely aggressive, especially since August of last year. Now, yesterday they came out, and they changed the short-term rate from 4.75 to the upper bounds being 5%. This is another 0.25% increase. And know that this is short-term rates. This is credit card debt. It is automobile loans. It is equity line of credit. It's not 30-year mortgages. As a matter of fact, yesterday, 30-year mortgages actually went down 0.25%. And but the Fed target rate, you can see over here, it is going up at an absolute incredible clip. It is the fastest clip since historically, since 1981, where they went from 10 to 20, but that was only a doubling. And yes, that's a big jump, but this time they went from 0 all the way up to 5% in such a short period of time as 0.25 to 4.75 to 5%, which is an over 20 times change in rates. They were going at an unprecedented speed. They were waiting for something to break, and they were expecting it to be either in labor, in the service sector. They expected to see some unemployment, maybe the economy overall slow down. But what they weren't expecting that was lurking around the corner was a break in the banking sector, and we saw that, and we went over that in last week's episode. So you're wondering what else is going to break? I don't know. And I don't really think the Fed really knows either. They can pretend that they know, but they really don't know every facet of the economy and know what's lurking around the corner. But I do know something they absolutely did break, and that is the housing market. But first, I wanted to talk about our sponsor, and thank you for the sponsorship, Professional TC Service. They know that real estate agents are inundated with paperwork. The average real estate transaction is 16 hours of paperwork. And you know what? Let Professional TC Service help you by performing those non-revenue tasks to increase your productivity and efficiency and allow you to focus on prospecting. There are 2 broker owners, over 20 years of experience, bilingual, superior service, virtual, flexible working hours. TCs are your taskmasters. TCs are a calming force. You can contact Professional TC Service and let them take care of your paperwork at 714-309-8732. That's 714-309-8732. Now, back to the program and the fact that the housing market definitely has been affected by these giant changes in mortgage rates, and it definitely has been broken by the Fed. Now, they talked about it in June of last year. He said that he wanted to do the Federal Reserve wants to see a housing reset. And what he said further was, what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level and that people can afford houses again. Now, he didn't explain what this housing reset, he didn't respond to this until September when somebody asked that. So what they wanted to see was supply and demand to be in better balance, so that they wanted to see more homes on the market and that demand come down a little bit so that values would come down and buyers would have their way. Now, this difficult correction should put the housing market back into better balance. Now, they expected prices to come down quite about 10 to 20% is what I determined is a correction in economics land, but we didn't quite get that. Instead, and I want to point this out, that in Southern California, the active listed inventory has changed dramatically when rates have gone up, and this is also true across the United States. But I have data going back to 2012 for Southern California. And what I'm showing you here is that the inventory, now the dotted green line are interest rates in 2013. They went from about 3.5 3.45% all the way up to a little over 4.65% in the course of the year. That's a little over 1% rise. Now, when you have that kind of a rise in rates and buying activity slows down and a lot of homeowners come on the market, the same number typically come on and then they linger and they accumulate on the market. Now, those black dotted lines, now that is where the inventory typically peaks in a normal year, but not in years where we see this phenomenon of rising rates. Instead, it peaks all the way in the fall. And when it peaks in the fall, it allows the inventory to continue to grow because we have the same number of homeowners coming on the market, and then it does not peak because a lot of those people languish, a lot of those sellers, and then they don't sell and they have to pull their homes off the market when it comes to the holidays because they were unsuccessful. Now, this happened also in 2018 where we went from about 4% to 5% in interest rates in the course of the year. Same thing. We had inventory, and you could see a little bit over about 27,000 homes, and made their way all the way up to close to 50,000 homes in the course of the year, and it did not peak until the fall. Then we had last year. And you could see, I'm actually showing you interest rates we know went up considerably more than just 1%. And we were getting that quick rise in the inventory. However, it peaked when it normally is supposed to peak between July and the end of August. Now you're wondering what happened, and what really happened here is you could see we went from we went up a whole percent by the time we got to March. So we started off the year right about 3.25%. We hit about 4.25% in March, hit 5.25% in April. So now you've gone up 2% since the start of the year. Then by the time we got to September, it went up 3% since the start of the year. And then by the time we got to October, it went up 4% since the start of the year. So a big 4%. So it went from 3.25 all the way up to it actually, for a few days, eclipsed over 7.25. It even hit 7.37%. That was the height for the year. Now you can imagine what happened was it hit a plateau earlier and peaked early, but the reason that it didn't continue to go up is because a lot of homeowners decided, hey, you know what, I'm not even going to move. So when values are coming down at a slower level, and also, you know what, they can afford to purchase and it's not that big of a change, they're going to continue to sell their home and buy something else. But when there's such a disparity in the interest rates, it creates quite a problem, and as a result, we have fewer sellers that are coming on the market. And this was already a problem with fewer homeowners on the market. You could see that the red line is where we were just prior to the Great Recession, and during the Great Recession, we had 4 million homes on the market across the United States. The black dotted line is where we were prior to, right prior to the COVID, and it was right at about 2 million homes. You could see what happened after COVID. It really drilled down really low, and I'm pointing to where we are today, and it's below 1 million homes on the market across the United States. Now, what this creates is a problem, what was referred to as, I call it hunkering down, or golden handcuffs, a lot of people call that. The bottom line is there's a lot of homeowners that simply will not move, and I've explained it in many different times. In January, February alone in Southern California, we were missing 41% fewer homes compared to prior to COVID, and that's the number of homes coming on the market. And this is the number of homes coming on the market each month, year over year. It's actually missing 17,400 for sale signs so far in the first 2 months. Based upon January and February, I did that dotted blue line, and this is where the number of homes coming on the market, we would miss over 100,000 homes in Southern California alone. Now, today, there are 19,100 homes on the market. Pre-COVID, there were 35,250 homes on the market. So you can see how low it is right now compared to where we were prior to COVID, and it's way lower than where we were prior to the Great Recession. So that's a real problem, and I'm pointing with that black arrow where we actually peaked. If we would have continued, if interest rates would have just gone up to about 5.5% and stopped, that line would not have peaked right there. Instead, the disparity wouldn't be that bad. There would still be homes that would come on the market. They would linger on the market. There'd be more accumulation, and we'd actually build an inventory. We would have built an inventory all the way up to about 40,000 homes, that purple line. But we did not. And the reason we did not is because interest rates kept on going up in the background, which is absolutely unhealthy, because now it exasperated, I think that's a word anyways, it made the problem even worse for the number of homes on the market. So the inventory crisis actually continues. Now on the demand side, of course, when you ratchet up interest rates, you're going to have less demand. And you can see it in this chart. This is purchase application index. This is from Calculator Risk Blog. Across the United States, it was up 2% week over week. This comes out every Wednesday. It's actually gone up for several weeks in a row because interest rates have been a little bit more favorable. It's down 36% though year over year because we're comparing it to last year. It'll be more comparable year over year by the time we get to the middle of the year around June. But you can tell that what's happening is that that this is really starting to eat into demand. And you can see it also in the demand numbers. This is a snapshot of pending sales activity. And today we're at 11,076. So it's kind of flatlined. It would have continued to go up. But part of the reason it's not going up right now is not because the demand is so weak, because it's already weak compared to prior years. It's because there's just a real lack of sellers on the market. Now, pre-COVID, there were 16,454 was the average, 3-year average prior to COVID, which is 49% higher. So demand definitely is down. And it would have been, it's more muted compared to prior years. Anyhow, it would be up from where it is today if there were just more homes on the market. Now, the market time, the expected market time, if you place your home on the market when you open up escrow based upon supply and our demand metrics, is today it's at 53 days. Now, right at 50 days or lower is where values are actually going up. About 50 to 55 there's kind of a balance. But there are many, many markets, such as that we follow, Orange County, San Diego County, that are far lower than this. And I think Orange County's at 42, and you've got San Diego County at like 36-day expected market time. Now, the 3-year average prior to COVID is 64 days. So this is below the 3-year average. And there is now what's going on, and you can hear it in the streets, and not many people even know about it. It drives me crazy. It's actually, there are open houses with lines of people going through. I've heard it from many, many different people, and there are so few homes available that when homes come on, that people line up and they're purchasing these things. And if they're priced right, that's key. Got to be priced right in this market. If you're priced right, according to your fair market value, you will have a lot of activity and you will have a bidding war. And there are bidding wars going on right now. And but you know what? One of the casualties of all this is we're still, it might be a hot market, but check this out. This is from California Association of Realtors. Look how the number of sales, the sales volume in California is so far muted. It's muted across the United States. It's definitely muted in California because California did a bigger swing because of its higher prices. And you could see there aren't that many markets. During COVID, it was a little bit less than where we are today, but then you have to drill back all the way to the Great Recession to find times where sales were even lower. But of course, that does not mean we're in a Great Recession at all, because there's this tug of war going on. And this tug of war is between it's a supply crisis, which definitely favors sellers, and then we have unaffordability, and demand is lower, which favors buyers. However, now last year and at the very, very start of this year around January, we had values really coming down methodically on a month after month basis. And that's because we had more supply, but supply kept on going down after peaking all the way back in summer. It's continued to go down. And in many markets I track, it's actually down half of where it was, where it peaked. And now it's really, really low. So you have a very, very low supply of homes matched up against a very, very low demand. But right now, the supply is winning, and you've got values going up in many, many markets. And as a result, Surprisingly to many home buyers that get into the marketplace, they cannot believe the amount of activity, and it's lining up in favor of the sellers in many, many cities and in many, many counties. You just have to look at the price range. Of course, the higher price properties are having a little bit more difficult time. But when I say high price, like in Orange County and LA County, it's below $2 million is not luxury. So it's pretty hot everywhere below $2 million. So if you want a copy of this, you need to be a subscriber to Housing Debrief. You can go to reportsonhousing.com to subscribe. And the latest report that came out on Monday is multiple offers again. The Orange County, LA, and San Diego got this week, and San Bernardino Riverside will get theirs next week. And if you want, you could utilize the coupon code BROKEN for a free month. And I encourage everybody to subscribe, and because I'll be bringing it the cold hard facts to everybody so that everybody can make proper decisions. So thank you for tuning in to another Housing Debrief. I hope you have a fantastic finish your week, and we'll see you next week with yet another Housing Debrief. Thanks much.